with chaos at the New York Stock Exchange.
Get back in there at once and sell, sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 1st, 2026. May 1st. Can you believe we're almost halfway through the year? Hard to wrap my head around. Hey, some big shout outs this week. Rochelle out there in California, Mike in North Carolina, Carla, another Mike in Dover, always sharing our stuff on Facebook. Thank you, Mike. Cameron, he's actually from the Bahamas in his heart. And then Mike and Carol from Dover. So all these Mikes, what's this, the week of Mikes this week. So thank you all for tuning in, all of you Mikes and everybody else, staying up to speed with what's going on with you and your money. So what's going on with you and your money? Well, the market pushed higher this week. Dow Jones up 0.5%, S&P up 0.9%, the NASDAQ up 1.1%, and the Russell Small Cap Index up 0.9%. So everything looking a little bit more constructive, everything holding together, pushing higher. You can thank earnings for that. We'll talk more about it in a moment. The volatility index, the VIX, Tom likes the VIX. Tom likes it ever since I told him about it. He likes to hear about the VIX. It was down this week, Tom, down 9%, down to a 16.9, showing some expected complacency in the market for some weeks to come. The higher it gets, the more excited I get to buy it. The lower it goes, the more concerned I get that we might get a bit of an upset. But anyway, that's the VIX. How about the long-term bonds? Well, they don't look so good. Down 1.2% on the week as rates went higher. And I have to tell you, Mr. Market is showing some incredible resiliency in the face of some pretty big macroeconomic stories behind the scenes. We'll circle back around and talk to all of them in here in just a moment. How about the sectors? Well, a mixed bag this week. We saw energy being the hottest, up 3.5% as U.S. and Iran tensions don't seem to be going away just yet. And I tell you what, there's more to that story. Look, I was listening to Paul Sankey just today. Paul Sankey is like maybe one of the top oil guys on planet Earth. And this guy goes to OPEC meetings, just a great oil analyst. He's talking about the fact that there's a really big disconnect right now between futures pricing, right? The pricing of oil on paper versus what's happening in the real world right now in regards to oil. So look, even if things were to calm down instantaneously and resolve themselves instantly with U.S. and Iran, there's some broken aspects in the oil market that could continue to cause some issues and drive prices higher here over the coming months. So just because that settles down doesn't mean that oil is going to turn around and drop like a rock, because there are some pressing issues there with supply and demand. Anyway, another big story with oil, the UAE pulled out of OPEC. So OPEC now is pretty much nothing but Saudi Arabia. So that's going to be a little bit more dislocation in the oil markets as well, because you're not going to have conglomerates deciding to increase or decrease production. So all things to watch in that regard. Okay, getting back to the rest of the sectors, kind of mixed. You saw technology up 1%, communication services up 1% thanks to Google. You also saw consumer staples up 1.1% and utilities up 0.8%. My point in calling those out is that there's no real clear messaging from the market in regards to sector performance this week. Just kind of mixed across the board. I think a lot of that can be attributed to earnings, which we will talk about here in a moment. How about gold and silver? Gold down 2.3% this week. And I think gold's going lower. I think it's going to break down below 4,000. I think that's where it's headed. It's definitely in a downtrend. I think it's definitely going to go lower. We're watching that closely because we would like to reestablish a position in gold. We had Kinross for a few years. We did incredibly well on it. Sold it towards the end of last year. Kinross Gold, it's a mining company out of Canada. And I would like to get back into the gold space. It looked a little stretched to us, so we backed out. It's correcting now, so we'll be watching that. And then silver, also down 0.7% this week. Silver really dished it out to people. and gone from 120 down to where it's at now in the 60s or whatever. So anyway, what's moving markets? Mainly earnings. Because let me tell you something. The market's got a lot of things that I think it should be paying a little bit more closer attention to. Okay. I mentioned a moment ago, interest rates going higher. Look, the Fed met this week, the Federal Reserve, Jay Powell and company, and the tone was this. They're not looking to be cutting rates anytime soon, folks. And I know they got a new sheriff coming into town, right? But Kevin Warsh can't just do what he wants to do. You have to have a majority vote. And I just don't think the data supports them cutting rates at the moment. And we're seeing interest rates reflect that to some extent. Not only that, I think Jay Powell is going to stay on for a while longer to be a thorn in Trump's side. He's going to stay on the federal governor's board. Won't be in charge anymore, but he'll still be there. So some more tensions and some headlines and stuff around that sort of thing. You got that. We talked about oil and disconnects there. Inflation numbers came out this week, still showing very, very sticky. There's the yen, the Japanese yen, and I'm not going to go into the monetary mechanics on this, but the Japanese yen gained incredible strength against the dollar this week. These are things that at any other time, I think the market would have reacted completely differently than it acted this week. I think at any other time, this market would have been lower, probably substantially on some of these headlines, but it continues to go higher because of earnings. And the earnings that came out this week, just knocking the cover off the ball. Look, you may recall 2 or 3 weeks ago, I said I expected a really strong earnings season. Well, it's stronger than I expected. It's stronger than market participants, economists, and analysts expected. It's been super strong. And so again, the market doesn't care so much about what you just did for me, like what have you done for me lately. It cares more about what you're going to do for me tomorrow. And earnings expectations and estimates have also been strong and rising. Now, all that said, I want to point something out to you. There's a bit of a diversion under the surface, okay? So what we're seeing right now, if anything is related to AI, and I just mean related, okay? So for example, when I say AI, you think computers, you think chips, things along these lines. I'm talking about things like Caterpillar, the big industrial company Caterpillar. Well, they went through the roof this week. Great earnings report. Why? Because they're building out all these data centers and because their diesel generators are being used to supply additional power and all these things. So it's not just related to chips and computers. It's also related to electric companies and industrials like Caterpillar. We may see other areas of industry really benefiting from this build out because when you listen to all the earnings calls this week from the big AI players, Google, Amazon, Facebook, et cetera, they announced almost $1 trillion. Let me say it again, $1 trillion with a T of AI build out spending. That is a lot of money, folks, a lot of money. And we're seeing it push these stocks higher. Now, you step outside of that realm, okay, and look at the rest of the market, and we are not seeing the same level of growth in earnings that we're seeing from the AI. As a matter of fact, this whole market, this whole big move up since the lows in March for the market, this big drive higher, has actually been driven by a really small group of stocks. It's not as broad as we would like to see, and I think it makes it a bit suspect. So, taking all this stuff, putting it all together, where do we sit? Economic data looks good. We got economic data this week. It's been pretty strong. Employment numbers looking pretty good. Lots of things looking good this week. You had earnings looking fantastic. Earnings expectations going up pretty strongly on some companies. At the index level, at the broad market level, the numbers look good because these AI companies are driving so much growth. But there's still some areas of concern. There's some big macro headwinds that are a little bit like concerning. Look, the bond market, folks, is way smarter than the stock market. The bond market is telling a different story. It's telling a story of greater caution than the stock market's telling. So what does that mean for us? It means we're going to stick to what we've been doing, okay? I feel like that blue fish in that kid's movie, Nemo, keep on swimming, swimming. Well, we want to keep on trimming, trimming. All right, so that's what we're going to be doing. Look, we trimmed one stock 2 months ago, and the daggone thing was up almost 100% last month. So I'm going to trim it again. I can't mention it right now because I haven't trimmed it yet. I'm going to trim it next week. I'll tell you about it next week. But I'm going to trim it again if it's holding steady on Monday morning. We're going to be looking to continue to just trim on these excesses, maintain the balance, maintain the diversity, because the way we're positioned right now, if the market wants to rip higher, we're going to participate. If it gets stuck and goes sideways, we've got some great yield. And if it does roll over and takes a beating, we've got some great hedges. I mean, we're really positioned for a market that's doing what it's doing, which is like bouncing all over the place kind of violently. So I like where we stand. We're going to maintain this optimistically cautious view of things until things change to a greater degree. So right now, we're going to hold tight, continue some trimming. We continue to work folks in on any days that are weak. So all you new clients, all you folks add money, we get a weekday or two in the market. We're putting it right into the models. We're not hesitating, keeping you invested because, again, we think the models are positioned for whatever the market can throw at us right now. And if we see a really big decline, well, then we'll change positioning and we'll get overweighted. But right now, I love where things sit. So I'm going to wrap up. Between now and next meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Take that big trip, buy that second house, pay for college. Hey, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.